When it comes to investing, very few books have had as much influence as The Intelligent Investor by Benjamin Graham. Originally published in 1949 and revised over the decades, it's still considered the Bible of value investing. Warren Buffett, one of the most successful investors of all time, called it by far the best book on investing ever written. But here's the thing, Graham wrote it in a US-focused context, and today's markets look very different from the mid-20th century. So in this video, we'll explore the first part of his ideas while adding a Canadian perspective, how these timeless lessons apply when you're investing here in Canada. Let's start with Graham's biggest message, the difference between speculation and investing. For Graham, an investment is something that, after thorough analysis, promises safety of principal and an adequate return. Anything else is speculation. That distinction is as important today as ever. When you buy a stock because everyone on Reddit or TikTok is hyping it, you're speculating. But if you study the company's fundamentals, assess its value, and buy with a margin of safety, then you're investing. In Canada, this applies directly to our market. Think about the oil and gas sector, which is often highly cyclical. Buying at the peak of an oil boom because prices are skyrocketing is speculation. Buying strong Canadian energy companies at depressed valuations with a margin of safety leans toward investing. One of Graham's most famous concepts is the allegory of Mr. Market. Imagine that you own a business, and every day your partner Mr. Market comes by and offers to buy your share or sell you his. Sometimes he's rational, but often he's moody, swinging from optimism to pessimism. If he's overly enthusiastic, his price is sky high. If he's fearful, he'll offer it to you at a bargain. Graham's lesson. You don't have to follow Mr. Market's mood swings. You can choose when to act. In Canada, this concept is powerful because our market can sometimes be even more volatile than the US, especially in sectors like mining and energy. Investors who stay calm when Mr. Market is depressed often find bargains in Canadian banks or REITs, while those who panic during downturns often lock in losses. Now let's talk about the two types of investors Graham identifies: the defensive investor and the enterprising investor. The defensive investor is someone who doesn't want to spend too much time analyzing investments. Instead, they focus on safety, diversification, and consistency. The enterprising investor, on the other hand, is willing to put in the effort, researching, analyzing, and taking a more hands-on approach. Most people, Graham argued, should be defensive investors, because realistically, they don't have the time, temperament, or training to outsmart the market. So what does that mean for Canadians today? If you're a defensive investor, that probably means focusing on low-cost index funds or ETFs. For example, the iShares S&P TSX 60 ETF, ticker XYU, gives exposure to the 60 largest Canadian companies. Add in an S&P 500 ETF for US exposure, and you've already diversified across two of the most stable markets in the world. On top of that, you can add a broad international ETF for even greater balance. It's simple, efficient, and lines up perfectly with Graham's advice to avoid speculation. For enterprising investors in Canada, Graham's approach would mean carefully analyzing individual companies, looking for undervalued stocks where the market price is significantly below the company's true worth. That might include buying beaten down but fundamentally solid companies like Canadian banks after a housing market scare or certain energy stocks after a price crash. But the principle is the same. Don't chase hype. Look for value with a margin of safety. And that brings us to Graham's most important idea, the margin of safety. This is the idea that you never want to pay full price for an investment. You want a buffer, a cushion, in case your analysis is wrong or unexpected events occur. In practice, That means if you believe a company is worth $50 a share, you don't buy it at $50. You buy it when it drops to $35 or $40. That way, you reduce your risk and increase your potential return. In Canada, this principle is crucial when evaluating industries that face regulatory or commodity risks. For instance, if you're considering investing in Canadian utilities or pipelines, buying with a margin of safety helps protect you against changes in government policy or sudden economic shocks. Another timeless lesson from Graham is the importance of investor psychology. He argued that the greatest enemy of the investor is not the market, but themselves. Fear and greed are the forces that cause most people to make bad decisions, buying high when markets are euphoric and selling low when markets are panicked. If you think back to March 2020, when the pandemic hit, Canadian stocks dropped dramatically. Many investors sold in panic. But those who kept their discipline or even bought when Mr. Market was fearful saw tremendous gains in their recovery that followed. To stay disciplined, Graham suggested strategies like dollar-cost averaging, where you invest a fixed amount at regular intervals regardless of market conditions. For Canadians, this can be easily automated through contributions to RRSPs or TFSAs. By consistently investing into index funds or ETFs every month, you smooth out volatility and avoid the temptation of trying to time the market. Graham also emphasized the importance of long-term thinking. He believed that while the market is a voting machine in the short run, reflecting popularity contests, it is a weighing machine in the long run, reflecting true business value. That means patience is one of the most powerful tools for an investor. In Canada, this is especially true for dividend-paying stocks, which can compound wealth over decades. Canadian banks, for example, have been paying dividends for over a century. Investors who bought and held through thick and thin have not only enjoyed growing income, but also long-term capital appreciation. One final point worth mentioning in this first part is that Graham strongly discouraged speculation in the form of trading, timing, or gambling on hot stocks. He wasn't against making money, of course, but he believed that the intelligent investor's first priority was the preservation of capital. For Canadians, that means not putting your life savings into a single mining penny stock or chasing the latest cannabis boom because it's trending. Intelligent investing is about building wealth safely and steadily. So to recap part 1 of this series, we've covered Graham's foundational principles: distinguishing investing from speculation, understanding Mr. Market, identifying defensive versus enterprising investors, practicing margin of safety, mastering psychology, and focusing on the long term. We've also applied these lessons to Canada, where diversification, dividend stocks, and disciplined investing through RRSPs and TFSAs can make Graham's wisdom practical for everyday Canadians. This is just the beginning. In the next video, we'll dive into part 2, where we'll explore Graham's strategies for portfolio construction, how to balance bonds and stocks, and what that means for Canadians in today's economic environment. If you found this video valuable, make sure to subscribe to the channel, hit the notification bell, and join me for the rest of this series on the Intelligent Investor, Canadian Perspective.